Ladies and gentlemen, good day and welcome to the UltraTech Cement Limited Q3 FY23 earnings conference call. We must remind you that the decision in today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risk that the company faces. The company assumes no responsibility to publicly amend, modify or revise any forward-looking statement on the basis of subsequent development, information or events or otherwise. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Atul Daga, Executive Director and CFO of the company. Thank you and over to you, Mr. Daga.
Thank you so much. Good morning and welcome to everybody to our earnings call for Q3 FY22. This quarter, if I can sum up in few words, it is much ado about nothing. That is what I would want to describe the quarter that has gone by. Coming to the brass tags, volumes are good, costs remain extended, and prices are stable, though we would have wanted them to be better. The focus of the industry is now shifting on to managing its costs, and let's talk about the emerging scenario on costs. The biggest one, of course, is fuel, and there are multiple factors that we need to keep in mind. The ongoing war situation, as you know, is one of the reasons for global fuel supply upsets. The only silver lining is that we have seen peak prices behind us and don't expect too much of volatility. A small decline in prices of fuel and we start celebrating. This is not the wisest things to do. These corrections are still significantly higher than the normal cost and quite often temporary. And like the stock markets, it is not possible for everyone and anyone to catch the bottom prices only. Second factor, of course, is China. As you are all aware, China has gone through the most turbulent time with COVID, and industrial activity had come to a grinding halt. The economy has just opened up, and I'm sure the consumption will rise. Some news articles said that 80% of the country had been already infected with COVID. The population has not grown at the pace at which India has grown, and India has become more populated than China now. China, in spite of their own capacities, has always been net importers. So as and when the industrial activity picks up in China, there could be definitely increase in imports in China, which will impact the overall global supplies of fuel. Third important factor to keep in mind is that there are no new petcoke capacities coming up globally, and cement capacity in India is on the growth path. So, in the long run, we don't expect any significant softening in fuel prices. As I said, the worst is behind us, so I have spoken about cost. Now let's look at the brighter side, demand. As expected, we are seeing the Indian demand surge at a fabulous pace. First 3 quarters have already generated a double-digit growth for us, and January-March quarter seems to be on a solid footing. The infrastructure story of the country is booming, as also the urban real estate continues to do well. This is where I believe UltraTech has got its expansion strategy bang on, and as always, a highly value accretive strategy. Our target is to start the next financial year with close to 130 million tons of capacity. Capacity utilization already improved to 83% in this quarter, in the reported quarter, and we expect it to go up further in the last quarter of the financial year. In fact, if I go back in the last few years, January, March have been typically 95% or 100% capacity utilization, and the way things are going, this quarter should be no less. Government focus on developing good quality infrastructure bodes very well for the Indian economy and cement industry alike. All the highways, DFC corridors that has been developed will help move goods at a lower cost, lower wear and tear of vehicles, which will ultimately help improve efficiency and reduce costs. Airports in India have been growing their network slowly and steadily. Smaller towns are getting connected. The last I heard was the government's plan to increase the network of airports in India from 137 to more than 200 airports. Metro networks already commissioned or under implementation in 27 cities in the country, and 17 more are on the drawing board. The natural extension of all this infrastructure growth is an improvement in demand for urban housing, and we are already seeing that right now. I believe we will see a strong growth in cement consumption in the country. With all the infrastructure growth happening, the other point to keep in mind is that the demand for OPC cement will remain strong and perhaps grow over the years. This is where, yet again, UltraTech is very well placed. As I mentioned in the earlier part, the first 9 months have already delivered a double-digit growth, and this Q4 remains strong, and the future quarters also are expected to remain strong. To quickly tell you about our expansion plans, the way things are going, we have already commissioned 6.8 million tons during the first 9 months and will commission close to 10 million tons in the next few months. Further, work has already commenced in full swing on the phase 2 expansion of 22.6 million tons. Long lead item orders have already been placed and civil work has already started at most of the sites. We should be able to deliver this capacity expansion on time by 25-26. Prices, it's the commentary is half complete if the prices are not spoken about. But we do not see a significant move in prices. I guess the demand seems to be so good that the industry is focusing on operating leverages at the moment. But in the current scenario, where several players might not have supplies to cater to the rising demand, prices seem to be safe. Unfortunately, higher prices than the current levels are required to cover the cost pressures. With the increasing capacity utilization, we expect prices should firm up. Sustainability continues to be our focus. We continue to march ahead in increasing the share of green energy in our overall fuel basket. With technology on pump storage and battery storage in the offing in the next few years, we are confident of reaching the milestone of 50% of green energy in our overall basket by 2030, and thus thereby reducing the requirements on fossil fuels. To conclude, I must share with you that cement industry in India and UltraTech seem to be going strong. Thank you so much. Over to you for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Indrajit from CLSA. Please go ahead.
Yeah, good morning. Thank you for the opportunity. I have 2 questions. First, on the mix between trade, non-trade, has it changed significantly quarter-over-quarter? And with elections coming ahead and infrastructure spend, as you correctly highlighted, picking up, do you think that non-trade would pick up more in this calendar year than what we have seen in calendar 22?
First, to your question on our mix, we hover around 66-67%. Our quarter might be up or low. This particular quarter, we were 66% on trade, and blended was about 68%. So the interesting point to first, Indrajit, is our trade ratio was 66% and blended was higher than the trade ratio, which means that blended cement is going in other areas, in markets other than trade as well. Secondly, I already mentioned we expect OPC or non-trade segment OPC sales to continue to remain strong as India sees a surge in infrastructure growth.
Sure. Thank you. My second question is if you can throw some more light on the Super Dalla unit. Where exactly are we on this? What is the point of contention and what exactly is the road ahead? I understand you have entered into arbitration, but what are the key milestones that we should look for?
Okay. So, the matter is sub judice right now, so I wouldn't want to color anybody's mind. It's under arbitration and perhaps will go through its own, find its own way, I would say, once the arbitration is over.
Okay, thank you. I have more questions. I'll join back with you.
Sure.
Thank you. The next question is from the line of Pinakin Parekh from JP Morgan. Please go ahead.
Thank you very much, sir. Sir, I have two questions. First is your commentary on pet coke. Now, even at current thermal coal prices on a per kcal basis, pet coke still remain relatively attractive. But you did highlight that given structurally India's larger capacity addition and no pet coke capacity additions globally, pet coke prices are unlikely to decline materially. Does this mean that at an industry level, the 1,000 rupee energy cost per ton, which the company was seeing and the industry was seeing, which is now at 1,800 rupees, we are unlikely to revert back even if coal prices were to come off 10, 20, 30% from here, and the new normal is structurally higher on energy cost front?
You are absolutely right, Pinakin. I think it's a new normal. Coal costs from a $70-80 are now on a converted cost basis more than double. So 10, 20, 30% reduction will still not yield those numbers of, I remember we had seen 950 rupees a ton energy costs also. So there is, in the near future, that does not seem to be a likely scenario. I don't know what will happen, how the world will change once and if the Ukraine war is over. So as of now, we are in a situation of extended fuel prices.
Sure, sir. My second question is on cement prices. Now, if we take a 12 to 18 month view, you have commented at the beginning of your at the call that even though the industry is seeing strong demand growth, the industry seems to be focused on meeting demand, and you do not expect prices to move. Now, from here, starting from March, April, you will be bringing on capacity. There will be other players who will be bringing on capacity. So at that point of time, the incremental supply is higher. And if the industry is struggling to take price hikes now when demand is in double digits, what happens to pricing in the latter part of FY24 when there will be large new capacities on the ground? Shouldn't prices correct from here then?
I wouldn't expect that because I believe that the demand will continue to remain strong, and in this fiscal 24 pre-election, things should remain stable. I request Jhanwarji to add further.
Yeah. So good morning to all of you. One, obviously the new capacity is going to be added by us as well as by the other players. But as you know, the new capacity generally takes its own time to ramp up actually. And particularly, we all know this is going to be the election year, not only for the central, but the number of state governments. I think the demand would be likely to be reasonably good, strong, robust. So we don't think there would be unusual pressure on the pricing front. But yes, you never know how the overall market shaped out.
So, Pinakin, to conclude what Jhanwarji also mentioned is that there shouldn't be any undue pressure on prices.
Mm-hmm.
I would, if I were to put it on a chart, it would be stable to rising trend only.
Sure, sir. And sir, just last one qualitative comment, if you can give us. The double-digit demand that the company saw in this quarter, how much would be driven by government spending on infra or the government projects? Would it be half? Would it be two-thirds? I know you cannot have an absolute number, but broadly just trying to understand the trend.
Institutional sales have been good, and during the course of the call, I'm asking my colleagues to figure out a number and tell you. You have anything right now?
Government, can I add?
Yeah, please.
Yeah. The government spending, particularly, the major segment is from the road and other segments. So it is somewhere maybe 18 to 20%, not more than that actually.
Means that retail demand continues to drive growth. Now, if we have grown 13% and maintained a 66% retail therapy, then it's balanced and moving in the same direction. Nothing untoward.
Sure. Understood. Thank you very much, sir.
Thank you. The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, my first question is on Dalla. Can you just explain us basically what led to the arbitration, what we are looking at right now? And secondly, what are the assets under contention? That's the first question, sir.
So the asset under contention is Dalla Super Unit, which we had already acquired. And as I mentioned earlier, right now the matter is sub judice under arbitration. So let's just let's complete that and then we can discuss it further.
Right. Sir, can you just basically highlight what is the capacity over here? Is it 2.3 million?
That's 2.3 million tons of clinker.
And sir, would it also have 150 million tons plus of limestones, basically when we bought from JP and JP bought from UltraTech from?
So I don't think we should guess because still the limestone is under the forest litigation actually. So as Atul said, it's a matter litigated actually, and would be unfair to talk much about those things because nobody knows what kind of results would be there.
Sure, sir. Sir, my second question is how should we look at basically the situation in Himachal Pradesh? Have we got some increase in market share over there? Because I think other leading player, they have some tussle with the transporters. So are we making good out of the scenario? How should one understand it? Or should we also hope that there could be some reduction in transport costs overall for the industry?
Yeah, just to answer your question. So first of all, once there is a shutdown of any plant actually belongs to any one of us actually in the industry, the natural supply happens from the different players actually. So if somebody assume that by the closure of the plant temporarily because of the transport union problem actually, I don't think there is a major swing in the market share or anything else. Yes, some here and there supply gets improved for a temporary period.
This is a temporary phenomenon.
But sir, are we vouching for a reduction in freight costs like what we have seen in Chhattisgarh earlier? I think cement mills basically they talk economics and basically they can actually play a hard ball versus transporters. So what is our thought process, or are we okay to pay say 10 rupees plus per kilometer per ton? How are we looking at the situation?
Ritesh, we are watching the market and we will see how to deal with the situation.
Nobody is okay to pay, but it's a problem since last not one decade, it's from 2-3 decades actually. So
we'll wait and see.
Sure. I have two more questions. If you allow, I can go ahead, sir. I'll join back the queue.
Let others take the questions now,
Sure,
otherwise you will complete the time. Yeah.
Sure, sir. Thanks.
Thank you. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, good morning, everyone. I joined the call late, so I just missed in case it was discussed. I just want to get some sense on the cost deflation that we expect in, say, fourth quarter. And also, I mean, with domestic coal availability improving, does it really swing the needle for us on cost in the medium term, or very little reliance on that?
So domestic coal, from kiln perspective is used very limited. It is mostly used for power plants. And we had a high cost curve Q3. I expect the fuel cost to be lower in Q4 for us as well.
Okay. So any quantification? I mean, just any broad range?
I don't want to give numbers for the future.
Okay.
Yeah.
Okay. So other than coal cost, fuel cost, and say operating leverage, any other cost items, any deflation in any raw material?
Others are benign. Others, not too much. Fuel is the biggest driver right now. Other point which I can add is on logistics front, when this quarter the busy season surcharge was brought back. Effectively, our logistics play has been good to be able to absorb that cost and continue to deliver more or less around the $1,200 per ton overall freight cost. This is in spite of that busy season surcharge getting added, which would be a significant portion.
Okay. And I was a bit surprised to see that fly ash cost index also rising consistently. I mean, any color? I mean, what's happening there, and is it like any temporary phenomena which is likely to?
Fly ash, it's all about availability. If one particular power plant is shut down, then suddenly there is a surge in prices, and availability is an issue. But you won't see prices coming down because the number of thermal power plants in the country is not going to go up, and fly ash consumption will keep going up.
Got it. And Atul sir, just if I could get your, say, margin expansion outlook in the medium term, say FY24, do we expect energy cost normalization and operating leverage to play a bigger part, or prices also should contribute equally, and you should have?
I think it should be a wholesome game. All the levers will play. It's only about which vehicle runs faster than the other. So you will have operating leverage advantage for sure. Hopefully, the fuel cost should remain range bound. We don't expect them to spike up dramatically, the way it had spiked up earlier. Prices should remain stable. I think you must have heard the comments earlier. Prices should remain strong, should remain stable, or in an upward move only.
Got it. And just one last question. I mean,
Can you come back?
Okay, I'll sure.
Other question.
Okay. Thanks, and all the best.
Thank you. The next question is from the line of Prateek Kumar from Jefferies. Please go ahead.
Yeah, good morning, sir. My first question is on your power and fuel cost. In your presentation on the energy cost trend slide, we have given this petcoke index, which seems to have corrected 20% or 15-20% from the peak seen in a couple of quarters back, while our energy cost index seems to be slightly higher. So does that just imply we could be looking at 20% kind of correction?
So it is a catch-up game. So we had exhausted our old contracts and low price procurement. October, December was our highest cost of fuel. I expect the curve to again narrow as we progress in the future quarters.
But just looking at the green line in that chart, our index has gone up from 131 to 175 for energy cost.
Yeah.
While the other line of petcoke has come back from 204 to 203.
Next quarter onwards, this 175 will also start dropping. So you will see that correction happening.
Okay, so that seems like a large benefit which might be coming on from next quarter.
Yes.
Okay. So secondly, on price comment of yours remaining strong or stable. So like in 2019, we saw like prices because of the strong volume trajectory in pre-election year, industry was not able to take major price hikes. So is this something which we are indicating that prices may remain like totally flat in first busy season, and industry might not be looking to reclaim like what profitability they want achieved in FY20 to 21?
Beyond a point, I think everybody wants price improvements, price increases, given the cost curve. So at the same time, nobody would want to lose on their market share. And typically in a very high growth time frame, focus will always be on meeting the demand. So I don't expect prices to crash, correct, but stable to upward move is what I could expect. When and how much is very difficult to quantify.
Sure, sir. And the last question, would you have like region-wise utilizations and pricing data for the quarter?
I don't have it right now. I'll give it to you later.
Sure. Thank you, sir.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit your questions to 2 per participant. If time permits, we will take the follow-up questions. The next question is from the line of Rashi Chopra from Citigroup. Please go ahead.
Thank you. I have 2 questions. One is on the, basis your commentary on pricing as well as costs. From an EBITDA per ton perspective, where should we kind of see it settling on the up move? Number one.
It should cross the 4-digit mark for sure. I would expect January, March itself should cross 4-digit mark.
Okay, thanks. And the second is any sort of update on your expansion to 200 million tons organically?
Yeah, so we have gone to the drawing board right now. The 22.6 is under execution, which will take us to 156. And once the concrete plan is ready, we will definitely announce it. So 28, 29, 30, it's a little fluid, but 28, 29, 30, we should touch that mark for sure.
Thank you.
Mines are in place, land is in place. It will be again a mix of greenfield, brownfield. So we'll present a complete picture.
Sorry, just to add to that, will it include any inorganic as well, or you can do greenfield, brownfield to reach 200?
We can do greenfield to reach our milestone. Inorganic is always a top-up opportunity because I cannot really forecast on that.
Thank you.
Thank you. The next question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Hi. Good morning, Mr. Raga. So just a couple of questions. Firstly, on the working capital release, in the presentation, you have mentioned the 500 odd crores of release in Q3. So how much more can we expect in Q4?
Q4 should also give a higher release only because, it's a high volume, high cash conversion quarter. So this quarter we ended with a negative working capital of close to 125 crores, 124 crores. I think this will just go up. There are, I'm glad you asked this question, Amit. There are some monies which are stuck, which we are trying to get released. This was the upfront fee payment, which was made, and then central government issued the order for paying back the upfront fee, unutilized upfront fee. It is at various stages of clearance in various states. So that will also help improve my working capital.
Okay, got it. And in the last quarter, you mentioned your fuel inventory had increased to 55 days. So, is it coming back to normal levels now?
March, we will. So, if there are opportunistic transactions, we will spike up our inventory, but will remain anywhere between 45 to 50 days. That is the norm that we will want to follow.
Right. And my second question is on blending ratios. Like, quite encouraging to see consistent improvement in blending ratio. So it's already gone to 1.42x. So, like, is it because like even the non-trade side of the business is accepting more of blended cement, or is it more a push of blended cement in the trade channels only?
No, it's a mix of everything. Firstly, consuming fly ash to the maximum possible, not going a 0.01% beyond the permissible limit. Second is obviously the advocacy program which we continuously run, trying to convince the institutional players to buy blended cement from us, because it's not that they don't blend, they do the blending. So I think it is our core competency and their core competency is construction and not blending. So people are getting convinced. Some institutional players are taking blended cement from us.
Right. And is there any number in mind that, let's say, 1 year, 2 years down the line, we should be 1.5x or anything like that?
It will be a desire to definitely reach 1.5x, but 1.42 we have already reached, so maybe 1.45 would be the next step to look for.
Got it. Thanks. That's all from my side. Thank you.
Thank you. The next question is from the line of Pulkit Patni from Goldman Sachs Asset Management. Please go ahead.
Yeah, no, it's not asset management, it's the research side. Atul, sir, my question is on pricing. Would it be fair to assume that it is not one or two players who, because of whose behavior prices are down? Is it just broadly excess supply in the market which has come into being in the last 2 to 3 years? Would that be a right assumption?
You're putting me in a fix, Pulkit. Let's meet for a cup of coffee and discuss it.
Sure. Okay. So second question is, despite our debt coming down, interest cost has gone up. This is just because of the interest rate readjustment.
So marginal impact of interest rate, but bigger is accounting on foreign currency revaluation. So we have $400 million of dollar bonds and lease charges. Yeah. So the various foreign currency components have to be, although it is fully hedged from the date the liability is crystallized, but accounting requires revaluation. So it's a revaluation. So cash flow versus accrual, there will be a big gap.
Got it. And so just very quickly, international operations, everything back to normalcy in terms of Sri Lanka, etc. now?
Yeah, the good news is Sri Lanka is back. I think I have somewhere around 65 crores overdue still to be received, but should get cleared by February, and the volumes have started picking up. Government is continuously giving additional LCs so that we are able to increase our exports. It has fallen to nearly 1/3, but I'm sure in the next couple of months or 2 or 3 months, it should be back to normal.
Good. Thank you so much for that.
Thank you. The next question is from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Good morning. So my first question was, some of the comments you made earlier in the call in terms of the share of OPC rising, like fly ash cost being sticky, and and even on fuel cost and all. So all of this is like margin deflationary in nature. So based upon that, are we kind of the view that structurally prices will go higher in India? Well, I'm not talking the next 6 months, 12 months and all, but do we need that, or we have to settle with lower profitability?
No, it is required. Yeah, everybody is raising prices. So prices are required. Otherwise, there'll be a huge amount of pressure on the margins, and especially for players with lower margins will have problems. So my expectation, my sense is prices have to go up. Otherwise, how will the industry be able to cover its costs and make money?
Yeah, at least it must cover the additional cost.
Yeah.
So at least the normal margins are maintained.
Yes. So like normal margins, Atul sir, what you mentioned, 4-digit, is that what we should think is a normal margin?
Yeah. 4-digit is the normal margin. 4-digit is also a wide range. I would love to inch back to 1400, 1500. But right now the focus would be to reach anywhere between 1000 to 1200 bucks.
Okay. In calendar 23, you mean?
Okay. Ashish.
Okay. Sir, secondly, on can you just quantify the impact of railway peak season surcharge this quarter? On a per ton for us?
So it was, I'll have to get it worked out, and I think I'll ask Ankit to communicate to you, because it was implemented middle of October. Yeah. So I'll get that impact sent to you.
No, so my question basically was also then, what has happened for us to maintain our, overall cost on freight side?
I'm glad are you giving us a compliment?
Yeah, obviously, because like the freight cost hasn't gone up as much.
Yeah,
so is there something which is
nobody asked, but we have managed our lead distances very well. So the market mix, plant to market combination, how we service the markets is being handled very well. A lot of work has been done on improving efficiency at the ground level, turnaround time of vehicles and throughput on vehicles, reduction of demurrage, wharfage. You name the lever, every lever is being pulled in the right direction. Just for records, our lead distance dropped to 413 kilometers this quarter as compared to 428 in the previous quarter. So that also helped a lot.
So if I can just squeeze one more question, on pricing, like whatever, we had collated, it seemed like pricing should be up quarter on quarter. So is it, like a regional mix which has changed this quarter, or if you can give some color on,
you will see region-wise, we are a pan-India player, so you might see lesser impact on our P&L as compared to our regional players. So just wait for some more results, you will have more clarity.
But our growth, was it more skewed in any particular
question,
region?
please, Ashish.
Sure. Sir,
we can talk separately, yeah.
Sure.
All right.
Thank you. The next question is from the line of Navin Sahadev from Nuvama Institutional Equities. Please go ahead.
Navin Sahadev from?
Yeah. Hello, good morning. Am I audible? Hello?
Yeah. The name has changed, Navin.
Yeah. Right, sir. Edelweiss has now renamed to Nuvama Institutional.
Okay, all right.
Right. So, sir, two questions. First is, of course, on the prices. Now, in North India, the demand seems extremely good. The largest player, large capacities in the region there are currently shut. So, there couldn't be more ideal a situation to take price hikes, more so in January with the beginning of busy season, busy construction season as we call it. Yet there is some downward pressure, marginal sort of a downward pressure. It's completely different to what generally can be expected. So what's really, is it just the high competitive intensity which is driving, or there is more supply that we are not able to really get the best price?
I think not, the prices are not going down, prices are stable. The market is just absorbing all the demand is getting serviced. That is the good part. And the moment, month of December, we were at a 92% capacity utilization. The moment industry starts going up and above 85% capacity utilization, there is no reason why prices will not go up. And history has it, every January-March quarter, if the capacity utilization at the industry, all India level goes up beyond 85%, it jolly well can happen this quarter also, prices will go up.
Yeah, no, fair. I would love to see that. Just that so far into January, I'm saying we are at 23rd Jan, yet no news absolutely of any major price hike or even small price hike from any part of the country. So just a little worried that if you are not able to take price hikes in busy season, should it not be a worry in the lean season?
Let's see. I am sure the marketing people are working on it. So we'll have to wait and watch.
Sure. So my second question is about the cost. Now, your presentation, you've given blended fuel prices of USD, like, 200 being flattish quarter on quarter. So just a few clarifications, first of all. This $200, is it like, includes both kiln and CPPs and all the domestic coal, an entire mix that we have put together? It's only for the imported portion?
For kiln. So fuel going into the kiln essentially.
Sure. So this $200 at current spot rates would be how much, sir?
Should be 175, 180 now.
180, yeah.
Understood. So that kind of a decline we can ballpark see in Q4 then. Perfect. That's what I wanted to check. Thank you so much, sir.
Thank you. The next question is from the line of Girish Chaudhary from Spark Capital. Please go ahead.
Hello. Yeah, good morning. Thanks. My first question is on capacity commissioning timeline. So guidance for the year was around 17 million tons, and like you mentioned in the PPT, you have commissioned 6.8 million tons. So if you can just guide us, when can we see this remaining 9 to 10 million tons?
So in the next 45 days, most of the capacity is getting commissioned.
Okay. Got it. And secondly, if I look at the demand slide which you have put out in the presentation, slide number 5, rural demand seems to have moderated, especially north, central, east. So if you can just help us with the rural mix this quarter versus last quarter, and also what are you seeing currently in terms of rural demand? Is it picking or is it same?
So, a trend in this particular quarter has to be, your views or analysis has to be restricted to this quarter. Next quarter it will change. And the way I think my analysis, interpretation of crops is that the harvest has been good, cash flows will be good. So April, June, you will start seeing rural demand in our charts also back to green instead of orange.
And even the
MSP is also being improved, I am told. Yeah. So things are positive for rural market. There's nothing. The only handicap which rural markets run, I would say time and again, is monsoons. If monsoons are bad, then things go haywire. Luckily, India has been having a good spell of monsoons over the last few years. So things are going good on the rural front.
Oh, fair. But if you can just help us with the rural mix.
In this chart of ours, my only concern is the infra central, where no new projects were announced. Everything has got more or less completed, and that is why suddenly we saw a complete slowdown. But the moment, and I think that government, UP government, is pretty aggressive in its growth ambition. So the moment they are back on new projects, this red spot will also disappear.
Yeah, and particularly now from March or April onwards, this Ganga Express Highway
that itself will trigger enough growth.
Just started, so it will give some relief to the central actually in terms of demand.
Got it. And lastly, if you can just help us with the rural mix this quarter.
How much?
62. Rural mix.
62% of trade, sorry. And trade was 66%.
Okay, got it. Thank you, sir.
Thank you. The next question is from the line of Rajesh Kumar Ravi from HDFC Securities. Please go ahead.
Yeah, hi sir, good morning. Two questions. First on the fuel cost. Would it be possible to share the numbers on per kilocal, the average fuel cost for the quarter?
2.6 per kcal.
Okay, and this is against Q2. What was the number?
Q2 2.5.
Okay, and this is the $200 now trending toward 175. Can we expect a similar cool off in your per kilocal numbers?
It should.
Okay, and is it like when most of the players in Q4 would be looking at good correction in the fuel prices, that may also, subdue price rise, pressure from the companies because margin expansion can be taken care of on account of this fuel cost savings?
It's a marginal saving only because, I would love to have fuel costs back to $80 and we are still talking about more than double. So 200 to a 10% reduction in fuel cost does not really help me improve my margin expansion. So prices need support
And on the electricity generation cost, what sort of savings, where are we on a per megawatts, per unit of electricity generated, sir?
In terms of cost per unit?
Yeah, cost per unit.
It's around 5 rupees.
Okay, you're already...
Sorry, 5 point. It's close to 6 rupees a unit.
Okay, so there you're not seeing major inflationary impact despite...
Yeah.
Okay, and second on the working capital side, we see that September quarter your non-cash working capital number shot up to almost 4,000 crores and versus 700-800 crore in the preceding reporting periods. So, and in this quarter, December, you have seen a cool off around 400 crore in that out of this 4,000 crore. So, are we seeing, and you guided that in Q4 there will be some higher savings compared to 400 crore. So, what sort of number are we looking to go back to a non-cash working capital levels below 1,000 crores?
Our ambition would definitely be to increase the negative working capital, which was 125. Yeah, 1,000 crores seems to be doable.
Okay. Great, sir. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Rakesh Raj from HDFC Asset Management. Please go ahead.
Yeah, hi, good morning, Mr. Jawar and Mr. Daga. Two questions from my side. First one, if you can just also talk about price trend between trade and non-trade in last quarter and how is it trending now? So that's the first question.
As far as the prices are concerned, I would say it's by and large in a stable zone actually. Definitely we would have loved to have the better prices, but I don't think there is a major change in that trend actually. The trade prices are marginally up actually, marginally, and non-trade is also in the same direction, marginally up, but not there is any significant change in that trend.
What Jawarji is saying is the pattern continues to be same.
Okay, got it. And the second question, unfortunately, again is on pricing itself. Mr. Daga, you maintained that fourth quarter we should see improvement in our profitability upwards of 4 digit. But given the context that the cost, essentially, especially on the energy side, will see some cool off, you will probably also have better operating leverage moving into 4Q. I'm still unable to understand as to why industry is not looking at reasonable price hikes in this context itself, because cost in particular you highlighted will not moderate significantly as we move forward as well, and fourth quarter is generally the best quarter in terms of utilization. So if 4Q is going to be only a better proposition compared to 3Q marginally, then FY24 doesn't look very great.
You want EBITDA improvement or no?
We do.
But then focus on that now. We'll deliver EBITDA improvement. Ab kahan se laate hain, let us also work.
Okay, but you sounded very conservative in terms of your commentary moving into next 12 months or so. That's the only concern I had.
So don't be concerned. Industry is in good hands.
Great, sir. I wish you luck for that. Thank you so much. Thanks.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Thank you for the opportunity. Sir, what was the fuel mix for this quarter? And in terms of the capex, previously we said that the 6,000 to 7,000 crore capex for next till FY25 yearly basis. So is that remains the same?
Yeah, the capex remains same. I think anywhere between 6,000 to 7,000 crores is what we will spend. Fuel mix?
89% imported coal and petcoke is the fuel mix for this quarter in Kiln.
Okay. And in terms of the, you have already mentioned that the remaining 9.9 million ton out of 19.9 million, the first phase expansion. the entire will be to start by fourth quarter. So what about the clinker? I think 6.4 MTPA clinker is also pending from that 19.9. So
clinker and abhi clinker kaun sa baki hai? It's only
Yeah, only one clinker. Yeah, the only one small debottlenecking of Maihar plant is pending. Otherwise, we have commissioned all the other clinkerization unit actually. Though the cement production is lower, so which will make up in this quarter.
Okay, and out of 22.6 MTPA likely to come by FY25-26. So how much and where we can see 2-4 million ton to come in FY24 itself?
We will target early 25 to start commissioning.
So any capacity to come in FY24 out of the 22.6 next phase of expansion?
Not at the moment.
Okay. All the best. Thank you.
Thank you. The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, two questions. One is, you have indicated a slide on construction chemicals. Also, you have indicated it's 50 plus products and growing.
Yeah.
Just wanted to understand if you can spell out any numbers, that's one. And what's the overall game plan in this segment, say 3 years out?
So, this year, if I look at an annualized run rate, we should be clocking 800 to 1,000 crores and continuously growing. At the same time, we will look at consolidation opportunities because these are very small consolidation opportunities. In case something lucrative comes by, we will consider that. The biggest play for us for construction chemicals is it gives the what should I say? It gives our offering or a complete offering as part of a building solutions play, and for dealers it gives them something additional to do instead of just selling cement. So the focus is to build on to the stickiness which construction chemicals will bring to the table.
Sure. And sir, my second question was on logistics. Is there anything different that we are doing now, given a lot of new capacities which are coming up across the industry? Anything more on coastal freight or anything more on adding number of silos? Sir, anything that you would like to highlight?
Lots of these are very, very micro things. So whether a silo needs to be added, it does get added as and when required. Ocean movement is obviously restricted to our coastal markets only. We are moving from our Gujarat plant to down south, right up to Colombo. We are adding a bulk terminal at Tuticorin port that will further bolster our supplies to the rich Tamil Nadu market. There's a lot of digitalization effort which is underplay, which is helping us optimize our logistics cost. Today, each dealer, each regional manager of ours or a territory manager of ours knows where the truck is, what time the truck will reach the destination, and how much time it will take to unload, and so whether it's which ultimately helps improve efficiency. So there are a lot of efforts which are being, a lot of investment being done and efforts being put in to improve the efficiency of logistics, which is now visible.
Sure. So just a related question. Does the DFC change things for us? Is it a viable proposition or it's still some way out before it actually becomes viable? And are we doing anything to make it actually viable for us?
DFC?
Yes, sir.
Yeah, so nothing as yet. There are small movements which have started, but I have seen government's big plans of increasing the rake sizes, capacity of the rakes going up, which will definitely help move bulk cement in a big way. So my guess is we'll have to wait for a couple of years more before it crystallizes into real benefits.
Sure, sir. Thank you so much. I'll join back. Thanks.
Thank you. The next question is from the line of Sanjay Nandi from Ratnavali Investment Private Limited. Please go ahead.
Yeah, thank you for the opportunity, sir. My all questions got answered. Thank you so much. Wish you all the very best, sir.
Thank you.
Thank you. The next question is from the line of Girija from Systematics. Please go ahead.
Hello. Thanks for this opportunity. Yeah, all of my questions are answered. But if you can tell me which reason we have sold more volume this quarter?
We have sold everywhere more. Don't worry.
Okay. Thank you, sir. Thank you very much.
Thank you. The next question is from the line of Rajesh Kumar Ravi from HDFC Securities. Please go ahead.
Yeah, just one follow-up question. This others, when you report where you say construction chemicals, UBS and exports, you mean these are all non-cement revenues, exports? Is it including any exports from India, cement exports from India?
Yeah, it's very small, about 40,000 tons. Yeah, which goes to Sri Lanka, essentially, our own bulk terminal.
Okay, so to say, sorry?
Next quarter onwards, I'll give the breakup.
Right, great. Because so that we can track the...
is gaining shape, and it will be
exactly
for us to highlight it. Yeah.
Great. And the same number, would you have for this others number for March 22 quarter, please?
March 22 quarter.
Exports and others.
The presentation, last quarter presentation is there.
Okay, okay, sir. I'll get it from there.
Yeah.
Thank you.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Sir, just a follow-up on the WHRS. So, by end of this, how much more we will be adding for till March, and then for FY24, how much more we will be adding WHRS?
30 megawatts this quarter. 30 megawatts this quarter.
December.
30.
No, in last quarter we have added 16 megawatts in WHRS. In March quarter we'll be adding again
30 megawatts, which will take us to what total? 238 megawatts. We should end with 238 megawatts of WHRS by March 23, and there will be further addition because in the next phase of expansion of 22 million tons, there is in all the clinkerization units we will have WHRS as well.
Okay. And sir, any broad idea in terms of the we have previously mentioned that 15 to 16 million ton clinker will be there part of 22.6 million ton expansion. Which region? Because previously for 19.9 we have given the breakup. Here the breakup is not available. So any
provided in our last presentation where we gave the detailed geographical analysis of where the expansion is coming.
No, sir, we mentioned about the grinding unit and not the clinker, where the clinker is coming.
So I'll ask Ankit to give it to you separately instead of rattling out numbers here. He'll give it to you separately.
And lastly, on the employee cost, sir, last quarter we mentioned that because of the incremental cycle, our employee cost has increased in Q2. But this quarter also the employee cost remain on the same. Rather, it should have a decline on Q2 basis. So will this 694 odd crore employee cost quarterly is the new normal?
Once the increase compensation takes place, that becomes there now for the next future quarters also.
Okay. No, I thought there may be some one-time incremental bonus would be there.
No, nothing one-off, but it's normal increment.
Okay. And in terms of the other expenses, do you want to highlight anything where we can see a further reduction in the other expenses?
We are continuously making efforts, and you will see it in our results.
Okay. Thank you, sir, and all the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. On behalf of UltraTech Cement, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.